Call your people and tell them tonight's plans are over, because the money system just blinked and the next blink could be a blackout. And the part that should terrify you is how quiet it was. While you slept, while you were scrolling sports scores or thinking about Sunday coffee, one of the most boring, most reliable pieces of global finance did something it is not supposed to do. It hesitated. Not a dramatic crash, not a headline-grabbing explosion, a hesitation. And in markets run by machines, a hesitation is the sound of a chain snapping. This is Vantage Economics, and I'm recording this on a weekend when the lights are usually dim, the human voices are gone, and the back-office processes do their housekeeping. Match records, reconcile positions, publish the routine reports that tell everyone what moved and what didn't. That's the plumbing. It's not glamorous, but it's how trust stays alive. Except right now, the plumbing looks contaminated. We've been watching a critical set of public data coming from the biggest U.S. derivatives venue for metals, an exchange so central that its numbers become the reference point for the planet. And we noticed something that doesn't fit. Reports that normally update on schedule started showing blanks, zeros, stale timestamps, and error messages right after one of the most violent weeks in modern bullion pricing. Coincidence? Or timing with intent? Because the timing is the entire story. Let's slow down and make this simple. Every day, there are two categories of information that matter if you want to know whether paper and physical still live in the same universe. First, trading activity. How many contracts changed hands? That's the noise. Second, delivery mechanics. How many claims turned into actual movement of metal? That's the signal. Those two sets of numbers don't have to be pretty, but they do have to reconcile. So why are we seeing volumes that suggest huge delivery interest while the delivery-related reporting either doesn't update, doesn't match, or produces figures that look mathematically absurd? Then today, the update doesn't come at all. A bland corporate notice appears. Technical reporting issues. That phrase reads like nothing. But ask yourself, does a system built on redundancy, backups, and nonstop security investment just forget to report at the exact moment it matters? Or is someone buying time? It's tempting to shrug and say, it'll be fixed Monday. But that mindset belongs to a world where entertainment apps go down, not the settlement backbone of a multi-trillion-dollar market. This isn't a streaming glitch. This is the scoreboard for ownership claims. When the scoreboard stops, you don't know who's winning. Worse, you don't know whether the game is still real. Here's the nightmare scenario being whispered by risk desks, independent analysts, and corners of the cyber world. The problem isn't a bug. The problem is that the ledger and reality stopped agreeing. And to understand why that rumor won't die, you have to look at the shadow narrative floating around critical infrastructure circles, a name that keeps resurfacing, Salt Typhoon, not a storm, an alleged state-linked intrusion campaign tied to China, accused of burrowing into telecoms, power systems, and other backbone networks. Most people hear that and think blackouts. But what if the real target is subtler? What if the target is settlement itself? Because if you can rewrite settlement, you don't need bombs. Imagine you're not trying to destroy the exchange, you're trying to ride it. You infiltrate the systems that prioritize, validate, and route orders. You slip in a silent rule, something that gives your flow an unfair right-of-way. Then you convert that advantage into the only thing that matters in a crisis, title to physical inventory. Now add the second move. You dim the reporting. You don't have to erase everything. You just have to delay, confuse, or suppress the parts that would trigger alarms. It is like a security camera showing yesterday, footage while people are carrying boxes out the back door. Is that what happened? I can't prove it. But I can tell you why this theory has teeth. The system appears to be struggling to publish routine delivery-related data. At the same time, the physical market is screaming that the metal isn't DET freely available. And that scream shows up in one place first, the spread. Let's talk about the spread that should not exist. Even with main cash markets closed, the world doesn't stop quoting. Dealers, electronic sessions, physical networks, prices still leak out. And right now, the difference between paper price in the US and street physical price in parts of Asia has blown out to a level that looks like a printing error. Roughly a $183 gap for gold between a New York reference and a Mumbai physical quote. Pause. Think about what a functioning global market does to a gap like that. High-frequency firms spend fortunes shaving milliseconds so they can catch price differences that last fractions of a second. If there's free money, they take it. If gold is cheaper in one place than another, they buy the cheap market and sell the expensive one until the two prices converge. That's basic arbitrage. That's the invisible hand with a server rack. So why hasn't the gap closed? Why is a $283 bill just sitting on the pavement with nobody picking it up? Because step 2 of arbitrage may be broken. To capture the spread, you can't just buy the cheap contract. You must also be able to obtain the underlying metal and deliver it into the higher-priced physical channel. If you suspect the delivery mechanism is compromised, if you suspect you'll be paid in cash instead of metal, then the trade becomes a trap. And that's when the bots back away. Risk managers flip switches. Liquidity providers step out. The market doesn't tighten, it fractures. In that world, you don't get one global price for gold. You get 2 realities, a screen price where promises trade, and a physical price where possession sets the terms. When delivery breaks, price becomes a rumor. Silver tells a similar story. The difference between certain Western spot references and Asian physical hubs has widened to multiple dollars, an order of magnitude beyond normal. Usually those gaps are measured in cents. When they stretch into dollars, the message is that the metal is sticky, hard to source, harder to move, and possibly being withheld. So what changed? Why now? Why this weekend? One explanation is chaos. Another is strategy. And this is where the story turns from glitch to pincer, because Chicago isn't the only place where the doors look partially closed. While U.S. reporting is acting strange, we are hearing something else out of Asia. Major custodial operations, especially in Hong Kong, have allegedly slowed or paused certain withdrawal and allocation processes under the banner of emergency cybersecurity maintenance. On paper, it sounds normal. Updates, compliance, threat mitigation. But think, if the world believes critical systems are under attack, cybersecurity becomes the cleanest legal pretext imaginable for freezing movement without admitting there's a shortage, and Hong Kong has a new tool for that. A critical infrastructure protection regime that took effect at the start of 2026, granting authorities broad powers to control or pause systems considered essential during a cyber threat. That definition can include financial clearing, custody, and vault-related logistics. Connect the dots. 1. A U.S. metal settlement data feed goes weird after extreme price action. 2. The cyber threat narrative spikes. 3. Asian authorities can plausibly say, we're locking down systems to audit for intrusion. The result? Metal checks in, but it doesn't flow out quickly. Exports slow, withdrawals get pending. In a tight market, delays are everything. It's not just a slowdown, it's a pressure cap. And pressure capped in one region becomes pressure exploding in another. This matters for one group above all, short sellers. If you are short metal through futures, synthetic products, or leveraged proxies, you live and die by the ability to close your position in an orderly market. You assume you can buy back. You assume metal can be sourced if needed. But what if both sides of the bridge are constrained? U.S. reporting and settlement uncertainty on one side, and an Asian vault and clearing lockdown on the other. Then you're in a building with exits that look open until you touch the handle. So what happens when electronic trading restarts? When the Sunday session opens and the first real orders hit a market that has been stewing all weekend? This is the unpause moment. Normally, price pressure vents gradually. Some buying, some selling, arbitrage smoothing everything out. But if the smoothing mechanism is offline, the first prints can jump. Not drift, jump. My base case expectation is volatility that feels like a malfunction. Gaps, thin books, and violent repricing, especially in silver. Imagine a fund that went home Friday short and confident. Over the weekend, they watch reports stop updating, watch spreads widen, watch Asian custody slow. Suddenly, the position isn't a bet on price. It's a bet on deliverability. When the bell rings, they don't manage risk. They smash the exit. They buy at market because survival beats elegance. Now multiply that behavior by dozens of funds and desks. Who sells into that? Not the usual market makers if they fear settlement risk. Not arbitrage desks if the delivery chain is unreliable. Not dealers if they can't hedge cleanly. You get a wall of buy orders colliding with a vacuum. And the price must rise until someone, somewhere, decides the number is high enough to part with real inventory. That's what true price discovery looks like. Ugly and fast. But there's an even darker lever that could get pulled, and it has a name that makes commodity traders go pale: force majeure. If an exchange claims its systems were compromised, if it argues that records are unreliable or that operations can guarantee normal delivery, contracts can be altered, trading can be paused, and settlement can be redirected into cash. In plain language, we can't give you the metal, so here's money instead. And then the fight becomes, at what price? The last clean close? The paper reference? Or the physical premium that the real world is paying? If cash settlement is imposed at a low reference while physical trades far higher elsewhere, then the check isn't a gift, it's evidence. Evidence that the paper claim was never as solid as advertised. A cash payout is a confession, not compensation. And what do people do with forced cash in a credibility crisis? They try to convert it into something that can't be paused by a server update. They run toward physical. But if physical is already tight, if movement is slowed, then the street price can detach further from the official screen. You could end up with a bizarre split reality, an exchange print that looks contained, and an on-the-ground price that says the asset is scarce. Does this mean every scary rumor is true? No. But do you really need every rumor to be true for trust to be damaged? Trust is fragile. It breaks on possibility. So let's strip away the theatrics and focus on the practical lesson of this weekend. A cyber incident, real, exaggerated, or opportunistically framed, has become the ultimate excuse for institutions to limit normal operation without saying the word default. If a firm is short of inventory or drowning in mismatched claims, technical problems buy time. Security review buys cover, maintenance window buys a pause button. And all of it shifts the burden onto the public. You wait, you refresh, you accept delays while the system reorders itself behind closed doors. If you're holding exposure that depends on counterparties performing perfectly, ETFs with opaque creation mechanics, unallocated pool accounts, heavily intermediated derivatives, this is your risk zone. Because your wealth is only as real as the chain of promises between you and the underlying asset. The market is already pricing that counterparty risk. That's what the spread is, a surcharge for uncertainty. It's the world saying, an ounce in hand over here is worth more than a claim over there. So what do you do with this information? You stop treating the story as entertainment and start treating it as a signal. If the data feed is inconsistent, if delivery reporting is delayed, if physical premiums are widening, and if custody hubs are slowing withdrawals under cyber pretexts, then you should assume the system is under stress, whether from attack, mismanagement, or both. And stress reveals what's real. The brutal truth is that modern finance runs on confidence and synchronization. When synchronization fails, you discover that some prices were more narrative than reality. When the electronic session opens, watch three things: liquidity depth, volatility at the open, and any language about settlement flexibility. If you see sudden halts, unusual behavior, or official statements that emphasize orderly markets over transparency, that's your clue that the priority is containment, not truth. Now, I'm not here to tell you what to buy. I'm here to tell you what this moment represents. The shift from a world where the ledger is assumed trustworthy to a world where the ledger is assumed attackable. And once that assumption changes, everything reprices, not just metals. Risk itself reprices. Because if settlement can be questioned, then the premium moves to whatever cannot be digitally rewritten. Physical assets, direct custody, reduced intermediaries, and yes, sometimes simply optionality, the ability to act when others are frozen. We're entering an era where cyber can be used like a curtain. It can hide losses, it can mask shortages, it can justify controls, it can slow the exit lanes. So as you head into Monday, don't obsess over the single headline. Watch the behavior. Who is publishing numbers, who is delaying them, who is widening terms, and who is telling you to be patient. And if you take one message from this, the moment the reporting goes dim, the premium moves to possession. If this breakdown escalates, the resolution will be one of two things. The paper price catches up violently to the physical world, or the paper venue loses relevance as the benchmark. Either way, the era of frictionless metal pricing is being challenged in real time. If this helped you think more clearly about what's happening, hit like and subscribe to Vantage Economics, because the next 48 hours may rewrite a lot of assumptions. And if you want one final question to sit with, when the scoreboard disappears, who benefits most?